head of European interest rate strategy at Morgan Stanley. Laurence Mutkin joins us from the bank's London offices. And actually, Laurence, I wanted to start by getting your reaction to this news. The Swiss National Bank saying that it's aiming for a substantial and sustained weakening of its currency, that it won't tolerate a level below the 120 mark. It also says that it's willing to buy foreign currencies in unlimited amounts. Can you just talk to me a little bit about the medium to long-term implications for both Switzerland and the markets in general?
Yes, I think the SNB has obviously spent a time of increasing frustration with the Swiss franc, and we think the reasons it's going up are obviously not because of fundamental valuations, but much more as a sort of safe haven, flight to quality asset. So in a way, Switzerland's the victim of things that are going on somewhere else, and the National Bank is stepping in this aggressive manner to try and cap this out. Our FX strategists think that on a fundamental view, the Swiss franc is overvalued and should fall through time, but clearly in the immediate effect of this is that safe haven flows are going to have to find perhaps somewhere else to go.
Yeah, so with that in mind, which safe haven assets do you think might benefit from the flows that would have gone towards the Swiss franc? German Bunds, perhaps?
Yeah, I think the evidence of the way that the German government bond market has behaved shows you exactly that kind of flow there. Although, to my mind, until the last couple of days, quite a lot of the movement we've seen down in German government bond yields could be explained not just by these safe haven flows, but also by a change in the outlook for interest rates at the ECB.
So with that in mind, what are you expecting from the ECB this Thursday? Change of course?
Well, I think at current levels of the Sept, the two-year German government bond, we need validation from the ECB to justify this level if it's to be anything except a safe haven flow. So what we need is to see, what the market needs to see to justify these levels is a change in the language, a change in tone from what has been a hawkish path. Obviously, the ECB's hiked rates twice by 25 basis points year to date, towards a more dovish path, and we are now expecting that the ECB will reverse both of those rate hikes during the course of the coming sort of 9 to 12 months.
So we're actually going to go in the opposite direction. So can you tell me then, what will weaker growth and looser policy rates mean for the markets? Will they be bullish for German Bunds?
Well, that has been the call, and it's obviously been right. As you said in your earlier report, we've got Bund yields dipped down below 188 yesterday, trading off a bit today. I think there's obviously, as you'd expect, there's some profit taking to be had, and peripheral markets are relatively quiet today. But broadly speaking, this new path of fiscal austerity and monetary accommodation in the context of weak economic growth should be supportive of core bonds, i.e. German government bonds, especially at the front end of the curve.
And I suppose worrying development that we've seen over the past few days, Italy's borrowing costs have been rising, trading above the 5% level, despite the fact that the ECB is still in the market.
Yes. The workings of the ECB buying program are not supposed to be, not designed to be desperately transparent. The market sees the SNB, as it's called, coming in at various times and various bonds at various levels. And I suppose it's fair to say that the level which the market had thought the ECB was committed to, 5%, was surrendered yesterday. Whether that is a permanent change in policy or whether it's dependent on the Italian budget process remains to be seen.
And Italy facing some substantial obstacles right now. They've watered down their fiscal reforms. Parliament is debating it today amidst a nationwide strike in protest at those austerity measures. What happens if Italy is downgraded? Are yields at this level pricing that in?
Well, I think the Moody's process is, Moody's obviously has a rating a notch higher, I think, than the other agencies. So I don't think that these yield levels are particularly dependent on individual rating changes. This is much more about establishing fiscal credibility over the medium term by the Italian government. And I think it's still possible if the political will is there, but as the evidence is, with the strikes, the protests, obviously none of these moves are popular in Italy as anywhere else. And the political outcomes all remain pretty unclear. And I think that's probably the development of that is, to my mind, more significant than individual rating changes of this order, at least.
And of course, all this is playing out against the backdrop of concerns about the banks. What are the financing markets telling us right now, Laurence? We've seen declines in bank stocks and the cost of insuring bank debt. That's been rising to records. Do you see some worrying parallels with 2008?
Well, the strange thing is, in the liquidity markets, that the size of the moves has been less than in the size of in the stock market. So we have a strange situation where the overall long-term solvency of banks seems to be more in question in the market than the near-term liquidity. And I think that's a function of all the of everything the ECB has done to put in place access to liquidity for the Eurozone banking system. So it's hard to, what I'd say is you're not going to look in the same place as in '08 for signs of stress. So just as the Swiss National Bank has stopped the Swiss franc being a barometer of that sort of stress, likewise ECB liquidity provision stops the financing markets being a freely moving barometer of that kind of stress as well. So I think I don't see those signs in the liquidity markets, but with this help from the central banks of the world, you sort of wouldn't expect to see those signs in the same way.
Really good to talk to you. Thanks so much, Laurence Mutkin, European interest rate strategist at Morgan Stanley. Thank you.